The Alpha Horizon. Thinking different. Acting aware.
Hi everyone, my name is Alberto Gallo and I'm a portfolio manager at Algebris Investments. The global pandemic has hit economies around the world and changed the way people and investors approach capitalism. Today we're going to talk about how the pandemic will impact capitalism, policy and markets, and whether we will come back eventually to the old normal that we had before the virus or to a new normal.
Will the global health emergency induced by the Covid-19 pandemic and its economic impact change capitalism as we know it?
We think the pandemic will accelerate history. A lot of trends in economics and policy which were already in the making will be boosted. One of them is governments will have a much stronger influence in the economy. 10 years ago, governments and central banks around the world bailed out their financial system in 2008. But these bailouts came without strings attached, and they benefited a lot more corporations compared to individuals. Corporate profits, for example, went up, and companies increased dividends and buybacks while wages didn't. This time around, we think that governments will be a lot more careful in attaching strings and restrictions to what corporates can do. Another consequence is central banks will be stuck and locked into an easing policy, keeping interest rates a lot lower for the forthcoming years, allowing governments to provide this financing to the real economy. But this also means lower returns for investors that buy government bonds, and potentially a little bit more inflation because of all the money that central banks will print to fund sovereign balance sheets.
Has the ability to react to this crisis provided a new scenario for international financial stability? Can we talk of a new distinction between strong countries and weak countries?
The virus has hit all countries around the world. However, the policy response, the intensity of the lockdowns, and the quality of healthcare systems has meant that stronger countries, richer countries, have had less deaths compared to countries which were poorer or less organized. Switzerland, Germany, Canada, New Zealand have fared really well in the fight against the virus. On the other hand, Italy, Spain, the UK, and also the United States did less well. In emerging markets, the virus presents an even bigger threat because countries with already low levels of wealth, high levels of poverty, and weak healthcare systems are getting challenged and recording still high levels of infection. This means that when looking at the investment process, it's very important to take into account the dry powder, the ammunition that each country has to stimulate sectors of the economy before even looking at balance sheets across corporates and banks. In other words, you may invest into a strong company but in a weak country which is not able to help that sector, and that investment may not go well. On the other hand, a weak company in a strong country may do better because the government has ammunition to help them.
How can we look at markets today? What are the asset classes and the countries we see value in?
As governments around the world spend more money to help private companies and banks to survive the crisis, we think the best investment opportunity is exactly in corporate bonds. If we look at the investment universe, we have, on the one hand, risk-free assets like sovereign bonds, and on the other, we have equities. Today, the picture is very different. Government bonds are becoming less and less risk-free. They're becoming riskier as debt levels go up. We will face a 2020 with 10 to 20% increases in government debt levels. On the other hand, equities are already trading at expensive valuations, with the Nasdaq up on the year and the S&P not far behind. This means that to some extent, the equities which are benefiting from the crisis, like tech companies, are not cheap. And the ones that are potentially being hurt by the crisis but surviving will face government restrictions on dividends or buybacks if they receive help. We think the sweet spot across asset classes is in credit, where currently investors can get around 6, 7 to 8% yields in high-yield rated companies, excluding the weakest sectors in the market. There is a caveat. It's very important, in our view, to choose the right sectors and the right firms. This is because some sectors are gaining from the crisis, technology companies, for example. Other sectors may survive the crisis, but there's also sectors which are losers. And these are the ones that were already losing before the crisis started. For example, retailers were getting hurt by online selling. Airlines were already in overcapacity, having invested in too many planes. As a result, when we approach portfolio construction, we focus on the winners or the survivors. For example, car makers, which may see demand contract for a while, but eventually will have a return to people driving their cars. So overall, we think that the investment environment will change. Governments will have a stronger impact on running their economies. Central banks will get stuck, locked into stimulus. But overall, corporate bonds and banks' bonds in solid names will survive. Thank you for joining us today. We look forward to bringing you more insights on markets and the economy from the Algebris team.
The Alpha Horizon. Thinking different, acting aware.